This is Climate Finance and the Carbon Market. We're today going to talk to Sam Gill, who's the COO for Sylvera, one of the rating agencies that has sprung up in the last few years around this idea that we need a standard way of looking at carbon credits. So we're going to spend the day, or probably about 15 or 20 minutes with me asking questions, and then Sam we'll probably ask you questions as long as you can handle, but probably we'll let you off the hook at about 30 minutes or so, if that's all right.
Yep. More than happy to.
Great.
Yeah.
Great. Cool. Well, let's get started. So, Sam, give us a little bit of a background on yourself and how you came to the idea for Sylvera. You're a founder. This is a startup.
Yep.
Although a fast-growing startup, you've had some great news, but give us that sort of initial vision. Where did you come from? How did you come up with this idea, and how did you put the initial team together?
Yeah, sure. So I actually started off my career as a lawyer. So qualified and trained at a US firm working in the City of London. So I was originally specializing in hedge funds formation and financial regulatory law. So I was working in highly liquid markets. And then a few years into that, I had a bit of an existential crisis about working for hedge funds in my 20s. I kind of, I really believe that, you should be trying to use your career to make the world a better place. And I don't really think hedge funds do that. I mean, you can argue that efficient pricing of assets has some social utility, but no, I didn't really feel like I was working towards a better world. So I moved from that firm to a firm that worked with closed-ended funds, and they, was working with a partner that was specifically focusing on ESG funds. So I was mostly then working on green infrastructure. And the firm I was working at the time had quite a established climate change practice, and they were working on a couple of carbon offset transactions. And I got pulled onto one of those transactions basically because this sort of legal structuring that sat above the offset project looked a bit like a fund structure. So I just got sort of pulled in to help out fairly casually, really. And then, I guess for want of a better word, just got a bit obsessed with the transaction. It was completely fascinating to me. So it was a project that was trying to protect a mangrove forest and also restore the forest. And basically the project I think it had taken about 5 years to get to the point where the project was almost ready to issue credits. And it seemed kind of crazy to me. The verification process was, incredibly arduous and time consuming. But on the flip side, there was an airline that was basically looking at taking off a lot of the credits. So they were looking at buying the majority of the credits. And the transaction just kept falling through because they seemed to not trust the quality of the credits. So I was like, okay, so we have on one side a verification system, which takes five years plus, and it's very difficult to get these projects to market. But then on the other side, no one seems to be trusting this system. And obviously I came from a highly liquid markets background. So, the assets that hedge funds trade multiple times a second. So I was like, right, what is present in terms of infrastructure in those highly liquid markets that are absent in the carbon markets? And I became increasingly concerned because, the voluntary carbon markets in their current form are probably the best mechanism we have at the moment to deploy significant amounts of capital into nature protection and restoration. And it just seemed inherently non-scalable. And so it was around then I met my co-founder through a mutual friend. He'd got a PhD in machine learning. He was a spatial data expert. And so we started to speak about, okay, well, what could we actually do to solve these problems? And basically our original thesis was that we had to produce machine learning models that use the satellite data to give better views on the performance of the project. So i.e., have the trees been protected? Have they planted the trees? Has there been a legal incursion? Is the project reporting correctly? And so that was our kind of original thesis. And we went and raised an early investment round on the back of that thesis. When we started to look really closely for our proof of concept clients at these projects, what we realized was that quality is a lot more complex than are the trees there, yes or no, because there's a whole accounting exercise that goes behind, the issuance in these projects. And then also you need to understand the counterfactuals that sit behind the projects and also the likely permanence of the projects. And so that's where this sort of idea of a rating system for offsets was born, because we found that, without a kind of standard ontology to describe project quality, it was very hard to have a serious conversation around a project's quality and to compare projects across the board. And ultimately, if you want a liquid market, you need a standard benchmark data set, and you need standard tools to assess project quality. Otherwise, the assets won't be fungible, and you won't get any degree of liquidity. So that's kind of how the company came about. I've touched on. There's lots to pack on that, but hopefully that gives you a bit of context.
Yeah, that's really interesting. What was the project? Can you share that?
It was. Yeah, I can. It's just been properly funded, like literally now. So this is 2 years later. It was the Indus Delta project. So it was the one that you guys are involved in. I know. Are you guys at least Respira's in it, Trafigura? Yeah. So literally, it's taken that long to get to the point where it's kind of like properly up and running. So yeah.
Well, we love the project. It's the Indus Delta Blue Carbon Project. It's we're going to talk about it in the class over the course of the next few weeks, but it's a mangrove restoration project in the delta of the Indus River, and it's a terrific project. Fantastic, theory and it's a removals project, and it's got this sort of very charismatic kind of engagement with local people. So it was fun. It's a very inspiring project. And I can see how you kind of said, oh, wow, how is it taking so long, and how has it become so complicated? And why instead of seconds in terms of trading and creating value, why is it taking years? And thinking about stepping into that. So that's a great background.
Yeah, because at the end of the day, like you say, it's a fantastic project. And I couldn't help thinking like, wait a minute, we need to be doing this. This needs to be able to be funded quicker. And we need to do this at 1,000x. We need to be rolling these out at like a really fast rate if we're going to make a dent in climate change. So I was like, right, how do we make this thing happen a whole lot quicker? And how do we do it, 1,000x the kind of the scale?
Well, it's funny. There's a lot of noise and a lot of press and interest in the carbon markets and in carbon projects in specific, in carbon offsets and crediting. But the fact remains that it's a very, very small industry still. Last year, the turnover in the carbon markets was $1 billion. This is essentially a tiny amount of money. I mean, it'd be great if we had $1 billion each, but if you're talking about trying to solve climate change at a global level, and only spending $1 billion a year on it, there's no way you're going to get there. So the point I think you're getting at is scaling up so that instead of $1 billion a year, it becomes $1 trillion a year market as soon as possible, driving finance to projects like the IDBC project. That's the critical thing. And so you basically said, all right, we need an infrastructure. A chunk of infrastructure is missing here. How do we step in and provide it?
Yeah, 100%. And that's part of our kind of vision. It's about building the infrastructure for the private markets, but then also increasingly we're thinking about how do we build the jurisdictional level in infrastructure, data infrastructure that allows this market to scale. So I think like the trends that I see are increasingly accounting and funding of these types of projects will have to occur at the jurisdictional level if we're going to get to the scale that we need to. And so we're increasingly thinking about how do we build the infrastructure that supports that level of activity as well. Because we're just razor focused on how do we make this market happen faster, faster and a larger scale. Yeah.
So starting with projects, sort of the chunk of the earth that somebody's actually doing something in, starting there, and then working in, let's say, counties or provinces, states, within, and then countries, and sort of defining, and you're very focused on forestry really. I think you have plans to come into other project types, but forestry is it is the biggest carbon credit sector. And so starting with projects, moving into the jurisdictions and trying to figure out how to help them define themselves. That's the path forward.
Yeah, 100%. So we're in negotiations with a number of national level governments in connection with some multilateral institutions to build basically jurisdictional level monitoring systems that have been properly calibrated with our multi-scale LiDAR technology that will allow them to provide high quality monitoring on an ongoing basis that's highly accurate and able to monitor degradation as well as clear cutting. And then also provide inputs to setting their FRELs, which for those that don't know what a FREL is, that's a forest reference emissions level. So that's basically almost like a jurisdictional level baseline. So I don't know if you guys know much about the theory behind like REDD+ projects, and I'm sure Charles is teaching this class, you do. So obviously with a REDD+ project, basically the rationale for issuing credits is that you're avoiding a deforestation scenario that would have happened without the project's intervention. And so in order to issue those credits, you've got to quantify what that deforestation scenario would look like. And basically for jurisdictional level REDD+, you need to do the same thing, but at a jurisdictional level, you need to say what would have happened at this country level in terms of a deforestation scenario, and helping provide the inputs that allows nation states to build realistic and defensible FRELs.
No, and that's a really critical piece, which is kind of missing at the moment, I mean, or done in a patchwork fashion with different methodologies, et cetera. And so you're really is not just providing services to the market, but it really providing an infrastructural basis for the entire, sort of for the global, UN system, essentially, for how do you manage this?
Yeah, that's the plan, because I think, if the question, like, the task at hand is not to let this grow incrementally over a decade. This needs to happen very urgently and very quickly. And there's a serious skill gap and capacity gap at the jurisdictional level for building this data infrastructure. So we see it as an urgent part of our mission to go in and support in the development of that jurisdictional data infrastructure as soon as physically possible. Yeah.
Great. And tell us a little bit about who your customers are and what they're concerned about. Like, just give us. We've just gone through an exercise last week. We just to give a little bit of background. We've covered all the sort of the policy background behind sort of everything from the UN down to a state level. We've covered the markets, the voluntary market, the compliance market, et cetera. But tell us a little bit about you're a private enterprise. You've been raising money based on making a profit, and you've been selling a product to customers and understand a little bit of what their concerns are. So give us a sense of 2 or 3 or 4 different customer types and or actual customers, if you care to, and what their concerns are and how they think about the world.
Yeah, for sure. So I think we kind of split our customer types into 2 key types. So one is a kind of like financial participant, and carbon growth partners would sit in that world. But you'd also include the likes of the large commodity houses, the banks, the commodity desks at the banks, and some of the intermediaries that kind of have been in the market for a while. So say, for example, your South Poles and others. And basically they're engaging in the market to make a profit. And so they want to make sure that they're accurately pricing the projects. So, they're paying the right price, that they've selected high quality projects, or where there are concerns about the projects, that they're not overpaying, and they want to understand the risks that they're taking on by investing in those projects. So, we've got a number of customers in that kind of space. So those that are basically engaging in the market to trade and then to resell on the credits. And then our other kind of what we call like our ICP and ideal customer profile would be a sustainability professional at a large multinational corporation. And those would be the likes of, for example, Delta Airways is a customer of ours, and basically, they've made a carbon neutrality claim or a net zero claim, and they want to ensure that they're buying high quality credits to comply with that claim. And it's really important for those professionals that they're buying high quality projects. They want to ensure that they won't receive some of the reputational risk and negative press that you've seen in recent years around buying poor quality offsets. But also, the overwhelming majority of these professionals, these sustainability professionals, they're doing their job because they care about what they're trying to achieve. And they really want to make sure that the investments that the corporations they represent are having the impact that they're aiming to. And so they want to ensure that they're investing in high quality projects that has the climate impact that they're asking for. So we basically either support typically people in the the financial or trading space who want to make sure that they're accurately pricing and identifying high quality assets and understanding the assets that they're investing and trading, and then sustainability professionals who are buying credits to comply with a net zero or carbon neutral claim.
Yeah, great. Just to kind of, we've also studied sort of the whole chain of sort of how the carbon credits come into being, and the students are clear on essentially the registry and the certification process, the VVB or verification / audit process that has to happen. So some safeguards are built in. The methodologies, for instance, the science based and peer reviewed and public commented methodologies. So they're familiar with kind of those safeguards that are built into the system. How do you differentiate? When somebody says to you, well, gee, it seems like there's so much time it takes. It took 5 years for Indus to get through the certification process and be audited and scrutinized by the registries. If all that's happening, why do we need rating agencies? What's the need for this? If all this stuff is happening anyway, what's the additional value add for Sylvera or another rating agency?
Yeah, so I'd say there are kind of like 3 key values that we present. So firstly, it is acting almost as a backstop. So although there are these layers of auditing and there are safeguards in the system, there still is quite a broad range of maneuverability that a developer and an auditor possesses in terms of how they spin up the project. And so what we see is a real variety of practices in the market. So you'll see some developers will take an exceptionally conservative approach to the extent where they could actually have issued up to double the amount of credits that they've issued, whereas some developers will take a less conservative approach. And there are occasions where the auditing doesn't seem to have been as robust as it could and should be. And I think it's necessary that the methodologies retain a degree of flexibility, and to be honest, a significant degree of flexibility, because these projects are very diverse. They're not homogenous. They're incredibly heterogeneous. There's a huge diversity of different landscapes, of different socioeconomic situations. And so it's really important the methodologies retain that flexibility. But because of that flexibility, you see a real diversity in the quality of the data and the design of these projects. And so, we essentially act as a backstop and catch, scenarios where things have gone a bit awry. And for example, a developer hasn't been conservative in its approach because, they come under a huge amount of pressure. Historically, the carbon prices have been very low. And so I think there's been a lot of pressure for developers to try and maximize their issuance. And sometimes that has led to quite clear cases where the modeling behind, for example, the baseline has not been conservative. So I see our job as to backstop that. Also, you tend to see that, sometimes there are issues that just come from a lack of sophistication by the developer. There are some developers out there that have access to GIS teams, spatial experts, teams of distinguished scientists. Some developers don't have access to that. And so, the design of the projects will suffer as a result of that. You also tend to see, some pressures from if the developer's having to use jurisdictional produced data, sometimes there are issues there in terms of the data sets, being comprised in an erroneous manner. So acting as a backstop, that's number one. The second is, not every corporate, and it's really not desirable that every corporate has the resources to hire a 5-strong team to due diligence on offsets. It's an exceptionally complex area. To really get a handle on the quality of an offset project takes weeks and weeks and really quite expert capabilities. And it's really not realistic to expect every large enterprise on the planet to have a team to screen offsets for quality. And so, as a ratings agency, the role we can play is basically an aggregator of that due diligence process. We can basically do it once for the whole market, digest all of that data, and then represent and pass it on in a very digestible manner to sustainability professionals. And that's where that liquidity piece really comes in, because if there's a data set that everybody trusts, that's really deep, that's comprehensive, that's been done in a highly professional manner, the sustainability professionals can just rely on that data set rather than everybody doing the due diligence exercise all the time. And that allows quick decision making. It allows leaner teams. It reduces costs. And so it's a benefit to the whole market to have this due diligence done in a centralized manner. And then I think the third function is basically, this market is, as you said, Charles, it's still in its infancy. It's still quite small. And it's still in that process of formalizing. And if you can get really robust entities that are doing huge amounts of due diligence with strong governance in place, that gathers the respect of the market and the regulator community, it will do the whole market a favor, because it will be seen as a sign of maturity, and it will allow and give people confidence to move into the market. And that's what we're seeing is some of the people who are using our services would not have engaged with the market if we didn't exist, because they wouldn't have felt comfortable to. And so, I see our job as well as just being a sign of maturity in the market and helping push forward that adoption curve.
That's certainly the way we see you and use you, and it really does. I mean, my group has conservation background professionals, in forestry oriented people. And so we know enough to look at a project, but we can't look at all the projects in the world. And so having you all have that completeness, the macro view of all that is really terrific and useful. One last question before I sort of throw you to the wolves. I mean, ask our students for questions. What sort of, how do you organize yourselves? How many people work for you, and what's your how does that work?
Yeah, so we've got a team of about 110 now. So we're growing fast.
Oh, big.
It's big. That team's split between a number of functions. So it's probably helpful to just walk through the process of creating a rating. As a way to explain the team, and then also we have a web app that displays the data, and also has built an API to serve to exchanges. So we have a software engineering team as well. But basically, our ratings start with the extraction of data from the project documentation that's available in the public realm. So we have an extraction team. That once all of the relevant data is extracted, that's then passed on to our machine learning and GIS teams. So they'll have to extract all of the relevant satellite data, run our machine learning models over that data set. So we have a large machine learning team and GIS team that serves that function. In order to enrich our machine learning models, we actually have field teams that capture ground truth data with basically, we laser scan the forest at multiple levels. So we also have field teams that supply data to our machine learning teams. So you've got extraction, ML, which is taking data from our field teams. You've then got GIS teams who interpret and apply the data from the machine learning. We then have our ratings team, which apply the ratings methodology, which was developed by our ratings methodology team. So we have our ratings framework team and our ratings production team, and they analyze all of the data from our spatial data, all of the data that comes from the project documentation, as well as other public documentation. They take all that together, they write up the rating that then goes through our internal audit team, and then is taken to the developers for review. So we have a developer liaison team, and then it's finally published on our app. So we have the software team that build and service that app and the API, which is serviced to the exchange. And then obviously we have a commercial team whose job is to sell it. We also have a policy team that works with the jurisdictions, regulators, and national level governments as well. So yeah, it's a really broad, we've got people with PhDs in physics, climate modeling, biology, ecology, sociology. We've got economists, geographers. It really is very much a team effort from an incredibly broad set of backgrounds. And it really is necessary to bring all of those specialisms together to get to an answer, because of how complex and dynamic these projects are.
And this is what it looks like.
That's the web app.
All those folks in your back end end up generating this outcome, which to me is a beautiful way of representing different levels of carbon credits, and your ratings go from AAA to B and
D, actually,
yeah, D, right. And just to click on one of them, this is a super easy way to I'll do the tour this time. You leave
there you are.
Essentially you go right down to really critical information, the rating itself, and this really goes to the heart of it. Like what's, is the ton of carbon, going deeply into that. These guys do a great job in Guatemala. Additionality, which is, but for the, carbon finance, would this project happen or not? And so you give it a 4 out of 5. Permanence, how long it's going to last. Co-benefits, who else is benefiting from it, biodiversity, local communities. And then you've got some nice analytical tools really for market players, how much has been issued, how much has been retired, what's been permitted, et cetera. And so it's a terrific platform for those of us in the market to get a sense of Apple, trying to compare the apples to the apples at least. So yeah, thank you for that. Thank you for the platform and for the great service that we get from you. I want to stop though and sort of make sure that our students get a chance to ask you questions if possible. They're not overly shy, so I'm hopefully they'll step up. Vivian, you've got your hand up. That'd be awesome if people could put their hand up, and then you can either type it into the chat or just raise your hand, and we'll let you go. So Vivian, go ahead.
I want to ask. So you're a credit rating agency. Does that mean how do you choose your projects? Are they from your clients? Do they have a list for you, or do you go out there and find and liaise?
Yeah, good question. So we basically, as a kind of like default rule, we're trying to work through the list of the largest and most significantly issuing projects. So we're just progressively working through the biggest projects. What we have done is given some of our early clients the ability to ask for a project basically to be bumped up the queue. If they, for example, they're looking at investing in that project, then they can get it bumped up the queue. But basically what we're trying to do is work through the largest projects to get the maximum coverage as quick as possible. Yeah.
Eva, you have a question?
Yeah, thanks. Thanks for joining us, Sam. I just wondered, what are the biggest challenges of Sylvera now from technology, operational, and business point of view? I know you mentioned that one of your pressing needs is to build data infrastructures with jurisdictions. Is that part of it, or are there other challenges that you guys face on those 3 fronts? Thanks.
Yeah, so I'd almost call that jurisdictional piece is almost like the second wave of our mission. So in terms of that's us kind of fast forwarding and thinking, right, what's the next blocker for the market? In terms of our immediate challenges, basically producing high quality ratings that have a consistent quality, that are accurate, consistently accurate, high throughput is exceptionally challenging. So basically it's the scaling of the production, which is the most challenging thing, because it's easy enough to do a one-off due diligence exercise, and that's actually how the market is kind of functioned until now. You've paid consultants to go off and do a research, and they'll go and give you a report. But to consistently rate projects against a framework and keep that quality high and make sure you're consistently getting the right answer, and to grow that throughput is very challenging. So that's probably our biggest operational business challenge at the moment is growing our coverage and making sure that we get the right answer every time. There are some technical challenges around particular geographical areas. So say, for example, producing ratings on dry land projects was very challenging because most models rely quite heavily on optical imagery, but because of the way seasonality works in dry land forests, you can't really rely on optical imagery in the same way. And so we had to rely very heavily on radar data. So for example, our machine learning team had to basically build a new generation of models to rate dry land projects. There's a similar type of project challenge in Colombia. Colombia is very cloudy, and so you have to build models that even go another step further in terms of relying on radar and LiDAR data. So there's some particular technical challenges, but I'd say like the most difficult thing overall is to keep on producing ratings at scale that are high quality and correct. Yeah.
Great. Aditi.
Yeah, thank you so much for sharing your journey. It was super insightful. I wanted to ask, have you ever like filtered out a customer for any reason, like said no to a customer?
Yes, for a number of reasons. Like we're working through kind of like putting out a public policy in terms of who we'll engage with at the moment. Probably most obvious is like, you know, in light of the recent invasion of Russia, like we turned away a couple of customers in light of that. But we're also considering whether we're going to require the customers that we engage with to have credible net zero trajectories. So that's something we're thinking through at the moment. There's a number of like quite difficult ethical issues in terms of the market. Because on one hand, you can say, look, you know, if these projects are real and they're impactful, it's better than nothing that they're engaging in them, and you want to support and make sure that they invest in real and effective projects. But on the other hand, you can make the argument that, you know, offsets shouldn't be used by people without credible net zero trajectories because you're just sort of allowing greenwashing. So there's a real kind of like ethical debate there, and that's something we spend a lot of time like talking about. Very conscious that when we make a statement, we want to stick to it and really stand by it. So we're making sure we kind of like debate that thoroughly before we take a public stance. Yeah.
Thank you.
Super interesting. Shamwai, do you have a question?
Yes, I thank you for the sharing. I would like to know what is the, since you have mentioned the companies do a lot of different jobs, different projects. So what is the most challenging part of the duties?
I'm sure if you asked everyone at Sylvera, they'd tell you that their job was the most challenging. I'd say probably the most challenging though is the ratings production director, because you're basically trying to, you know, we talked about how, like I mentioned, how many different disciplines and different moving pieces going into the production of a rating. And so orchestrating that, making sure that moves reliably, that the output is high quality, like that's a really challenging job. We're actually like hiring for that at the moment. That's kind of been MVP'd by a number of the team. And we're actually looking at kind of ex-military logistics hires to do that. So it's a really challenging role. Yeah.
It's sort of a judge, jury, and executioner role too. And there's a lot of pressure on somebody who's putting the actual final rating number on it. And I think that definitely sounds like a tough job to me.
Yeah, 100%. And that's why, you know, we've built up our internal audit committees, and we're building a governance structure as well to sit above the whole production system as well. And that's why we have the developer redress process as well, because we're really conscious that you need checks and balances. No system is perfect. If you're planning to rely on a perfect system, you're planning for failure. So you need to build those checks and balances into your operational cadence. It's a challenging role.
Yeah, I've had discussions with some of your staff about how projects can actually move themselves up the rating, and what's the sort of the recipe for improving their ratings. And I think there's a really healthy thing to be able to do, right? If you've got a rating that's a double B, but you know, in order to get people to be more interested in investing, it's got to go to A or triple B. You need to know what the roadmap is to go from point A from that, you know, B to triple B. And is that something through the developer redress process that you have that you're managing, or is it another kind of way, or people have to make their own way, or?
You know, at the moment, that's pretty nascent discussion for us. I think, like, you know, increasingly we're speaking with people like yourselves who are investing in projects at the kind of like design phase or early issuance phase, and they're sort of saying like, look, is there a way that we can ensure that we bring the project to market with a high rating? And that's basically something we're like looking at the moment, because like absolutely we are able to provide that input in terms of like, you know, and that's actually something we've done a couple of times for our early customers. So we're really just building a kind of thesis on what that potential service would look like. But yeah, we are seeing demand for that.
Yeah. We've got a couple of questions in the chat. Let's see. Sammy's asking how your client acquisition project works. Like, how do you find clients?
Yeah, really good question. So kind of business 101, you have like your outbound motion and you have your inbound motion. Your inbound motion is driven by your marketing activity. So, we post thought leadership, we host webinars, we attend and speak at conferences, all your stuff, we have a PR director, so, speak to the press. So all that sort of activity to build a brand. So trying to raise awareness so that when people are buying offsets and they run into challenges selecting high quality projects, that they're aware of Sylvera, and then they come and approach us and say, hey, can you help? So that's your kind of inbound motion. And then your outbound motion is basically, we have a team of account execs that literally started this week. Up until now, it's been myself and Patrick, our VP commercial development, who's been doing that. But basically what we do is we look at a lot of the registry data. We look at kind of like publicity and sustainability reports, and we see who is buying credits, who's buying significant amounts of credits and would need our assistance, and then we reach out to them. So it's a mix of inbound and outbound marketing. Yeah.
And we got another question sort of about who, is it the sustainability department that's buying, or is it just, do you actually have or subscribing to your service, or is it you find individuals, or is it the treasury? Like, who's actually your connection in these companies?
Yeah, that's a really good question. I think it depends on the level of sophistication of the client. So in the early days, and probably only, up until only a few years ago, like offset prices were very low. And, the purchase of offsets were usually something done by a marketing team, actually, to try and kind of like green up the credentials of the brand. And so, often it would sit in a kind of like marketing or sustainability teams. What you're now seeing is like, obviously the commitments are actually quite significant in terms of like monetary value. And so you're starting to see the more forward-thinking entities are actually shifting this spend to like the procurement or treasury teams, because they're now looking at multi-million-dollar, multi-year contracts, and that kind of like starts to push outside of the competency of your typical sustainability lead. So we'll either be talking to a sustainability professional or someone maybe in the CFO's office or the treasury team. So it would depend on like, the size of the corporate's commitment. Yeah.
Interesting. Got it. And then Eva has got another question. So what steps do you take on sort of validation and checks and balances processes to ensure the quality of the rating? I think you spoke a little bit to that in terms of but that sort of that quality of rating is obviously critical, and a lot of people are depending upon it, both as you issue it and then over time. How do you manage that?
Yeah, so I mean, there's QA processes built in throughout the ratings process. So at the data extraction stage, we have software that the extraction analysts have to enter the data into, and there's basically like automated QA checks, and we usually have like double entry validation. So we have sort of automated via QA steps. When we're developing the machine learning models, before a model is actually able to be released into deployment and production, it goes through a manual validation step as well, where basically we'll take high-res imagery, compare the model output to the high-res imagery, and like manually validate that model is performing well. We'll also check it versus the LiDAR data, which is often used as a kind of like benchmark for accuracy with these types of models. So there's validation at the machine learning stage, at the GIS stage. And again, there's like validation steps and double data entry. We have QA and audit teams. So basically we have to build that in throughout the whole process. And then when a draft rating is ready to be released, obviously it goes through the developer redress system where we pass the rating past them, ask them if they've got any inputs, and then it goes through our audit committee as well. So it's a kind of mix of manual validation, automated QA checks, internal audit processes, and then also the developer having a say. So a huge amount of work goes into that, and always looking to improve that. There's always a way to improve your QA processes. Yeah.
Great. I think the last question I think we have is from Soman Chung. Does the financial sector client, care about how you're monitoring these credit projects, and especially are they looking for you to look back on an annual basis or periodic basis at the projects? And explain a little bit, I guess, on that. Like, how do you treat different vintages or issuances of credits in the rating process?
Yeah, there's a few questions there. So in terms of how financial sector clients think about the credits, I think you've got to think about, why is a financial sector client engaging or trading these credits? And ultimately, they want to resell on the credits at a profit to a corporate buyer, so that the corporate buyer can then retire the credits and make a claim against it. And so we tend to find like the financial sector clients are really quite concerned about quality, because they've got a reputation to uphold with their client base. You know, if you're Citibank or JPM or Morgan Stanley, you don't want your clients saying, "Hey, you sold me some dud offsets." That's not a good look. But also, if they buy a poor quality offset and the corporate community are increasingly demanding high quality offsets, they actually have then bought a useless asset, because they're not going to be able to resell it on, and they might be able to sell it at a low discount to some of the types of trades you see that use lower quality offsets, but they may make a loss on that. So, you know, they're concerned about quality because of the reputational risk, and they're kind of like making sure that they have an asset that can, you know, it's a pricing thing. So that's how they think about quality. You tend to find they might be a bit more kind of like robust in terms of their risk appetite. You know, I've spoken to some financial participants that are actually looking at buying lower quality credits because they think there's a good turnaround potential for that project. You know, for example, it could be rebaselined, or they could reduce the issuance to meet the verification, you know, the data that we produced on the carbon score, so that, you know, they could potentially resell it on at a profit if there was like a turnaround aspect. So, you know, you tend to find like financial clients will be a bit more sophisticated about how they think about risk, but they very much want to understand the asset that they're purchasing so that they can correctly quantify that. I mean, that's their job, isn't it? Risk mitigation and management. Sorry, there were multiple threads to that question. What were
sort of that annual sort of that annual. How do you look back at projects?
That's a really good question. So vintages. In terms of like how we re-release the rating quarterly. So every quarter there's an update cycle for the rating. So we're keeping the projects under constant monitoring, and under certain circumstances we will actually engage in an off-cycle re-rating. If, say, for example, there's a really material adverse event in the project area. So we're basically keeping the projects under constant review. What does that mean for a financial participant? Well, it actually means, you know, if you buy a bar of gold and you hold it in your vault, you know, that bar of gold isn't going to change its composition or its qualities. The price of gold might fluctuate, but you're not concerned that the gold's going to fundamentally change. If you're a financial participant and you buy a credit from a project that's looking strong, and then a quarter later there's a massive fire in it, actually the quality of that credit in some ways has changed in that. So, you know, in terms of if you're a financial participant, you are very concerned about that, because there's a risk to holding the credit. The other aspect is that older vintages tend to sell for less. And there are a number of reasons for that. You know, a lot of that is driven by the credit's eligibility and the vintage eligibility under the NGO and the GEO and the CORSIA schemes. So that is driving a kind of differential in vintage pricing. And you also see a kind of, people take a kind of rough rule of thumb that the older vintages, it probably likely to be a little less quality, a little less high quality. So you see a differential in terms of the vintage pricing. But, you know, we produce our scoring on a vintage level, and so there is a differential as well in terms of the quality of different vintages. But that's quite a complex subject to touch on in 60 seconds. But you do see it affect pricing for sure. Was there another aspect to that question?
I think that was it. I think the last question we've got, sort of, what do you mean by good quality project, and what are the criteria you're using? We talked about it a little bit when I showed your screen, but if you can kind of run through, like, what's good?
Yeah. So, you know, when I think of a good quality project. And when we think of quality, we think of like three key aspects. We think of performance. So has the project said what it would do and actually done it? So how has it performed? And inherent in that is a question around quantifiability. So like, can you accurately quantify and measure the impact of that project, and how has it performed? So that's the first thing you need to be looking at. So a good project is one that gets 100% on our carbon score. So we're saying that the data we're producing means that 100% of its issuance is justified. And in many projects, you'll actually see a positive delta there. They might get 120 or 150, 160%. And that means there's conservatism built in their reporting. And so, you've almost got an inbuilt buffer there. The second thing we look for is good additionality. So there are kind of like conceptual or tests of additionality that come from typically the CDM additionality tooling. So you'd be asking things like, is the project economically additional? Is it in terms of local regulation? Is it additional, or is this just something that's required by law? Is this common practice? So there's these typical tests of additionality that we apply. But then, if a project is additional, you also need to question, like, if almost always you'll be engaging in some sort of counterfactual when you're looking at a carbon credit, and you also need to be asking, how have they quantified the business as usual scenario or the counterfactual? Because that can lead to overissuance. So we look at additionality in terms of like those traditional tests of additionality, but then also how have they quantified the counterfactual that sits behind that project, because there's potential for overissuance. And then the third thing we look at is permanence. So how likely is it this project is going to be storing or avoiding emissions for a significant amount of, a geologically significant amount of time? And I think in the medium term, you'll see projects, you'll see credit prices normalize per ton year. So you'll basically see comparisons on that level. The market's not really there yet, but I think that's definitely coming. So you need to be looking at, how has this project performed? Is it additional, and how have they quantified its the counterfactual? Is there any potential overissuance? And then how permanent is the credit? Those are the three key aspects you should always be looking at. And then we provide data on co-benefits because that's actually a really important aspect of a credit, but we don't actually put that in our core rating. Yeah.
Gotcha. All right. One last question, which I think is a good one from Wenro Yu. What's the future market for rating agencies? For what's it look like? Play the tape forward 3 or 4 years. How you guys, for us, are a critical player in this market. What do you think this looks like going forward?
Yeah, so I think increasingly what we'll see is, or my hope is that the ratings will have driven fungibility and standardization in the market. And so you'll see kind of pricing versus ratings. You'll see standardized instruments that are grouped on ratings. For example, the Sylvera Prime contract, where you only can get prime level projects delivered into it. So yeah, like I would hope to see, and then also in the upstreams of see ratings actually written into sort of offtake contracts and a key part of how projects are taken to market. So that's kind of where I see the market. I also start to see like the prospect of jurisdictional level ratings for jurisdictionally issued credits as well, and those ratings being integrated into Article 6.2 trading as well as 6.4 and the VCM. And I'd also see, potential that the ratings could be used to help develop connectivity between compliance markets and voluntary markets, and that as the market, the VCMs mature, that jurisdictions become increasingly confident to allow VCM projects into their compliance markets, as you're seeing, for example, Singapore doing, South Africa, Colombia. You're seeing all these sorts of examples. I expect that to see that trend grow and potentially ratings actually being part of the data infrastructure that gets an increasing number of jurisdictions, happy and confident to do that.
Yeah. No, I think that's right. I one of my other clients is the Hong Kong Exchange, the big stock exchange here in Hong Kong, and the CEO is a former JP Morgan banker, and his view on this is ratings in this sector are everything. He said basically this is the absolute spine and backbone of the system, and to develop this kind of this industry is the critical factor for success for the carbon markets. So he's a big backer of this idea, and maybe Hong Kong will step into this into the carbon markets in a way that engages on that front. Well, Sam, you've been super generous with your time, and we really appreciate it. It's awesome to get you kind of live. Normally, I just interview people because our class runs from 7 to 10 o'clock at night on a Wednesday, and but since it's the middle of your day, it was great to be able to kind of pick your brain and have our students have a chance to ask you direct questions. So thank you so much for your time. I won't keep you too much longer. I know you've got the rest of the day to go to.
Brilliant. Well, guys, thank you so much for being so engaged and asking such great questions. And yeah, Charles, thanks for having me on. It's been a pleasure.
Yeah,
pleasure. More than happy to answer any other questions if you want to check them over by email. But good luck, guys.
Yeah, we're doing these guys are all PhD and master's level students, and they're going to be looking for jobs soon. So I know you guys are hiring.
Always hiring. Yeah, please reach out.
We'll send them in your direction.
Awesome. Thank you so much, Charles. Take care.
All right. Cheers.
Bye,
Thanks,
bye.
Sam.
Bye.
Bye.